Darune, as I promised, here I'm going to discuss couple of activities with regard to adjustments, and today I will discuss bad debts and depreciation. Not all the activities, limited activities, because the rest we will discuss in the classroom. And however, I will discuss few activities with you right now. So make sure to complete your notes, and you can ask questions as well. Don't hesitate to ask questions. You can raise questions in the classroom, right? So make sure to complete your notes. Okay, dear children, you can see a question from bad debts as well in your handout. So first place, let me tell you about bad debts. So simply bad debt means not recoverable amounts from debtors, irrecoverable amounts that cannot charge from debtors. So as a result of selling goods on credit, we can see receivable amounts from debtors, receivable amounts from customers. As a result of credit sales, because of selling goods on credit, we can see receivables to the business. We can see receivables to the business, dear children. Normally, such receivables we recognize as debtors, receivables from debtors. Debtors are assets. Debtors means receivables are assets, no? Now the thing is, due to being bankrupt or due to a death of a debtor or due to any other reason, if the business cannot recover certain amount, if the business cannot recover these receivables, then definitely here you can recognize an expense. So bad debts means, dear children, an expense. According to advanced level, we call this as impairment loss on trade receivables. So actually bad debts we need to recognize as an expense. Because of bad debts, what happened for your debtors? Debtor you need to de-recognize. Certain amount of debtors, the debtor value, my dear children, decreases. Right? Because of bad debts, debtor value decreases. So debtors are assets. Here we need to de-recognize asset, and on the other hand, we need to recognize it as an expense. So actually this is a non-cash expense. Mudalin api kaatawat gewanna ඕනේ නැහැ. Because in the classroom I explained you the definition for expenses. So always we don't have to pay expenses in cash. So there are non-cash expenses too, like depreciation, bad debts, discounts allowed, right? So when it comes to bad debts, actually what happened for the assets? Assets decrease. We don't have to pay in cash, but our asset value decrease. Debtor asset decrease. We can see an impact on debtors. So on the other hand, we need to recognize this bad debt as an expense therefore. So dear children, I will show you the dual effect first. Here we can recognize an expense. Therefore, asset value you need to de-recognize from that amount. So when increasing assets debit, when increasing expenses debit, when decreasing assets, we need to credit. So this is a double entry. Here is a double entry. So my dear children, what's the double entry for the bad debts? Bad debt account debit, debtors account credit. Bad debt account debit, debtors account credit. So when you write double entry for the bad debts, you need to debit to the bad debt account because you need to recognize here an expense, dear children. Bad debt account debit. Bad debt account debit. And because of recognizing bad debts, what happened to our debtor asset? Debtor asset we need to de-recognize, debtor account credit. Okay, so now we can go for the activity, dear children. Bad debts means certain amount that cannot charge from the debtors. Therefore, these amounts we need to recognize as expenses, and because of bad debts, what happened to our debtor asset? Decreases. Got that point? Okay. Activity number 5. Accounting balances related to debtors of Nava's business for the year ending 31st of December 2024 are given below. So these two balances were extracted from the trial balance at the end of the year. We can see two debtors, debtor receivable from Sarah as 40,000, debtor receivable from PL as 35,000. Refer the handout. So at the end of the accounting period in the trial balance, you can see two receivables. Normally we can see as same as other account balances. In the trial balance, we can see debtors also. Most probably we can see debtors. Now, however, next to the information given under the trial balance, you can see a couple of additional information. At the end of the year, Write off 10% as bad debts from debtor Sarah. And our management decided to write off 10% as 10% as bad debts from receivables from Sarah. And again, write off 5,000 as bad debts from debtor called Pia. So here, from both debtors actually, you can see certain amounts that we need to recognize as irrecoverable amounts. So dear children, look at the requirement, record necessary journal entries relating to the adjustments and prepare the relevant ledger accounts. So you know we need to record adjustments directly in the general journal. When recording transactions should record in prime entry book first, then we can post in the ledger. So bad debts also you need to record in a whatever prime entry book. You can try the cash book. No, you can't record it there. You can't record in the bank account, petty cash book, sales journal, purchase journal. So you need to record in the general journal. So quickly prepare general journal, get ready. We have two adjustments here. Right, okay. So let's record the first adjustment. Write off 10% as bad debt from debtor called Sarah. So how much is a receivable from Sarah? 40,000. You can see receivable from Sarah as 40,000. So now we need to recognize 10% out of this receivable 40,000, 10% as bad debts. So 10% value is 4,000. Now let's record, my dear children, bad debts. Let's take this into accounts. You need to recognize bad debts as an expense. So bad debt account debit, bad debt account debit, when increasing expenses debit 4,000. Therefore, what happened on the other hand? Because of recognizing bad debts, what happened to the debtor receivables? Decreased by 4,000. So debtor, if you want, Sarah account credit, debtor Sarah account credit, right? So according to O levels, we maintain personal accounts also. No? So bad debts debit, debtor Sarah account credit. It's okay. So after recording this, you need to briefly explain. You need to write down a narration recording bad debt of 4,000 rupees. Recording bad debts of 4,000 rupees. In on the other hand, in so we can write down, instead of this, my dear children, we can writing off 4,000 as bad debts from debtor receivables of Sarah. Writing off 4,000 as irrecoverable amounts from receivables from Sarah. Right? Okay. So let's move to the next adjustment. We need to write off another amount. Write off 5,000 as bad debt from debtor called Pia. So directly the value has given here. Business recognize 5,000 as an irrecoverable amount. So bad debt account debit once again 5,000. And this time this 5,000 we can't collect from our debtor called Pia. In our debtor PL, debtor asset, debtor receivable from PL, we need to de-recognize. So debtor PL account credit. Whatever the debtor asset, because of bad debts, debtors decrease as debtors are assets when decreasing credit. So now you have to write down narration. Writing off 5,000 as bad debt. Right. Writing off 5,000 as bad debt from debtor PL. Right, okay. So dear children, this is how we record journal entries for the bad debts. Right. So we need to present these in the ledger as well, because you know after recording transactions in prime entry books, next thing is we need to update these in the ledger as well. So let's prepare the ledger now. Right, okay dear children. So according to the trial balance at the end of the period, we can see receivable from Sarah. Receivables are assets. How much is receivable before making these adjustments? Receivable from Sarah was 40,000. So why did I record in the debit side? Because this is an asset. Assets when increasing debit, general balance debit. How much was the receivable from PL? It also given at the end of the year. So according to the trial balance, it was 35,000. Debtors are assets when increasing debit, general balance debit. So forget about the adjustment. You can see receivable of 40,000 from Sara. You can see receivable of 35,000 from PR. So these are normally personal accounts. So according to the A levels, we can just prepare directly a debtor control account by representing the total receivables from debtors as 75,000. What are the receivable from Sara 40, receivable from PR 75. Now, according to the management, according to the additional information, dear children, I think you remember we written off 4,000 as bad debts from receivable from Sara and 5,000 from Pia. So anyway, dear children, let's record these separately. Let's record these separately. How much did we write off from Sara as bad debts? For 10%, right? So bad debt account debit. Now you can update these in the ledger pute. Bad debt account debit 4,000. Debtors Sara credit 4,000. So because of bad debts, what happened to the debtors? Here I'm decreasing. Bad debt recognize expense by debiting and credited to the Sara. How much did we write off here as bad debts? So once again, bad debt debit. How much? 5,000. Debtors credit, debtor PL credit. Bad debt by 5,000. Okay, directly if you want, bad debt debit 9,000, debtor Sara credit, debtor PL credit separate. Okay, so you know this bad debt is an expense account. Take the total bad debts. Now in the account you can see 9,000. So bad debt account is an expense. So you can transfer to the P&L to the 9,000. When calculating profit, here is the amount of the expense that we need to recognize. Now carefully balance of Sara account. There was a receivable of 40,000, but after recognizing 10,000 as bad debts, how much is a real receivable? This is an asset account. We need to record this in the SOFP. So how much is a receivable amount? 36,000. You can bring forward at the beginning of the next year as balance brought forward 36,000. Okay. Dear children, look at debtor PL account. There was a receivable of 35,000. Record here 35,000. And we just waive off 5,000. We just recognize impairment loss as 5,000, just bad debts as 5,000. After deducting that, how much is a receivable? That is 30,000. And how much will be the receivable from PL? 30,000 at the end of the year. It should be 30,000 after deducting 5,000. So at the beginning of the next year, we need to bring forward assets when increasing debit, general balance debit. So at the beginning of the next year also, we can see the receivable from PL as 30,000. The next thing is, now we need to present the extracts of financial statement. We can present there the impact of bad debts, dear children. Right. Okay. So let's present, dear children, the impact of bad debts for these financial statements. So you know bad debts as a distribution expense. Why, my dear? Why do we need to recognize bad debts as distribution expense? Bad debts, we had to recognize bad debts because of selling goods on credit as a result of a distributional activity here. Now we can't recover certain amount from debtors. So bad debts you need to recognize as a distribution expense, sales related expense, distribution related expense. So, however, here you recognize certain amount as irrecoverable amounts from debtors. Debtors are assets. So here, dear children, no point in presenting separately. The debtors directly we can present at once. Before deducting bad debts, how much was the debtors? You can see in the trial balance, you saw receivable from Sara as 40,000, receivable from PL as 75,000. Together 75,000. Sorry, receivable from Sara as 40,000 and receivable from PL as 35,000. Tell me the total receivables debtors 75,000. Normally we have to record 75,000 in the SOFP, no? But dear children, you written off, right? You written off 10% from receivable from Sarah and 5,000 from receivable from Priyal. Total was 9,000, 4,000 and 5,000. So after deducting bad debts, after recognizing bad debts of 9,000 from these debtor receivables, you can't present debtors here as 75,000. So when you record debtors as 75,000, that is incorrect, no? Through preparing financial statements, we need to present accurate information to the stakeholders. So don't show 75,000. Make sure to deduct bad debts amount from here. Then how much should be the real debtors, the real receivable amount, the amount that can collect from debtors? 66,000 rupees. So debtor assets decreased from 75,000 to 66,000. This decrease in asset, on the other hand, we need to recognize as an expense, so that is called bad debts. How much is the total bad debt of the period? 9,000. In a Harima Saralai, this is very simple, dear children. Asset decreased by 9,000. So here 9,000 we transferred to the P&L. After deducting from here, we transferred it to the P&L, because when decreasing asset here, you can see it as an expense, right? So no need to record 75,000 minus 9,000. Directly you can record the real debtors as 66,000. Understood? And after deducting debtors, because of decreasing debtors due to bad debts, we need to recognize bad debts as an expense. So dear children, I think this is very easy. What's the double entry for the bad debts? Bad debts debit, debtors credit. Bad debts we need to recognize as an expense, and because of bad debts, what are the debtor asset? Debtor asset decreases. Right? I think this is clear for you all. Right, okay, let's discuss answers for the activity number 8. The financial information related to calculating annual depreciation of a non-current asset has given as purchase cost of the machine 950,000, fixing charges 55,000, annual depreciation percentage has given as 10%, finally the scrap value. So what you have to calculate here is cost of the machine. First we need to calculate cost of the machine. So write down this as activity number 8. Roman number 1, put Roman number 1. Then we have to calculate cost of the asset first. Cost of, what is asset here? Machine, right? So here you can see information related to a machine. So first of all, you need to calculate cost of the machine. So cost of the machine includes purchase price, as well as not only the purchase price and expenses that incur when bringing the asset into current position. Expenses that incur when bringing the asset into current position, like carriage inwards, import duties, when clearing from the harbor, as well as expenses that incur when turning the asset into usable condition. So simply the cost comprise with purchase price of the asset, as well as expenses that incur when bringing the asset into current position and turning the asset into usable condition. So dear children, here you can see the purchase cost of the purchase price of the asset as purchase price of the machine. Purchase price of the machine as 950,000. 950,000. And you know, here you can't see any expense that incur when bringing the asset to the location, but you can see when turning the asset into usable condition, here incurred an expense of 55,000 called fixing charges. So until fixing, business can't get the desired benefit throughout this asset, no? So fixing charges also we need to consider as cost of the asset. So that is 55,000. So now it's ready for use. So come on, this is the cost of the machine there. So here is the cost of the machine. That is 1,005,000. 1,005,000. So now we can move to the next one, depreciable value of the machine. According to the second question, you need to calculate depreciable value. Depreciable value. Depreciable value. What do you mean by depreciable value? in Sinhala share kala hakiyage. That means, dear children, when there is a scrap value, what do you mean by scrap? First place, certain amount, the net amount that can obtain by selling the asset at the end of the useful life. At the end of the useful life, thereafter there is no any use, no. There's no use that we can get out of the machine, no. So at the end of the useful life, business can dispose the asset. පැහැර කරන්න පුළුවන්. So when disposing, we can see net amount that can obtain through selling the asset. So if you want to calculate the depreciable value, you need to, what you have to do, you need to deduct scrap value from the cost. So cost minus scrap value is a depreciable value, because at the beginning as an outflow we can see a certain cost, but at the end of the useful life, through selling the non-current asset, can cover certain amount from the cost, can cover certain amount from the cost. So depreciable value means difference in between cost of the asset, cost of the machine minus scrap value. So here you calculated according to the Roman number 1, cost of the asset as 1,05,000. So if you want to find out the depreciable value, the maximum amount that can depreciate throughout the estimated useful life of the asset, you need to deduct here scrap value, the amount that can obtain at the end of the useful life. So how much can obtain through selling the asset? 5,000 can recover. So after deducting that, how much can depreciate as a maximum throughout the estimated useful life? That is 1 million. That is 1 million. So here is the depreciable value. Here is the depreciable value. We need to complete these, right? So according to the first question, we calculated the cost of the machine. It has 1,005,000. And then we calculate the depreciable value. You know how to calculate the depreciable value now. From the cost, you need to deduct the scrap value. Right. So let's move to the third one. Here you need to calculate the annual depreciation amount. Annual depreciation amount that should depreciate during a particular year. So you know the equation, you know how to calculate annual depreciation. So annual depreciation expense equals, so I taught you in the classroom, I taught you a method of depreciating. I think you all remember that. We can calculate annual depreciation based on the straight line method. That means each year we need to depreciate an equal amount. So how do we calculate? First, from the cost, we need to deduct the scrap value. That means here is a depreciable value, cost minus scrap value. Then normally we have to deduct by useful life. But if you can't see a useful life, then you can multiply the answer by annual depreciation percentage. So here in this question, annual depreciation percentage has given. Right? So dear children, here the cost is 1,005,000. Cost of the non-current asset 1,005,000. Scrap value is 5,000. So you already know the depreciable value as 1 million. How much do we need to depreciate per annum? Here it has given as 10%. So dear children, after multiplying 1 million by 10% per annum, in other words, annually, we need to depreciate this asset by 100,000 rupees. We need to depreciate the asset by 100,000 rupees. Right? So normally, if you can't see an annual depreciation percentage, 1,005,000 minus 5,000, cost minus scrap, divide by useful life. Divide by useful life. So I will show you a relationship in between annual depreciation percentage and the useful life. Useful life of the asset. If the annual depreciation percentage is 100%, that means you need to depreciate the asset by 100% at once. So useful life will be 1 year. If the annual depreciation percentage is 50%, you can depreciate the same asset by 50% each year. That means you can depreciate the asset during 2 years. per year by 50%, you can depreciate during 2 years. If the annual depreciation is, dear children, let's take 25%. That means useful life is 4 years, right? So you have to divide, you need to divide 100 by 25. 100 divided by 25, sorry, right? So that means during 4 years, you can depreciate this non-current asset. If the depreciation percentage is 25%, you can depreciate 4 times. If the depreciation percentage is 10%, gets the annual, gets a useful life. Actually, it is 10 years, right? Each year we can depreciate 10. So 10, 20, 30 like that, we can depreciate 10 times. So 10 years should be the useful life. So here in this question, 10% means, so without multiplying, 1,500,000 minus 5,000 divided by directly 10 years. So 1 million after dividing by 10 years, you can get the same answer as 100,000 rupees. So annual depreciation is 100,000 rupees. So here you can see the answer, right? Now we can move to the last question of this activity number 8, that is journal entries relating to the adjustments. You know, so far we talk about accrued expenses, income receivables, bad debts, and here we are talking about depreciation. And all these are adjustments. Where do we need to record adjustments? First, all transactions should record in a particular prime entry book? No, before recording them in the ledger. So these adjustments we can record in the general journal. So prepare general journal as soon as possible, and let's pose the double entry for this annual depreciation. As I told you earlier, adjustments we need to record in the general journal. So what is this adjustment? Depreciation. So you know, because of depreciating, let's see the dual effect first. Depreciation we need to recognize as an expense. Recognizing means increasing. So expense, you need to recognize expense here. So expense account debit. And what did we depreciate? A non-current asset. Therefore, asset value we need to de-recognize. We depreciated a non-current asset. Because of depreciating, asset value should decrease. When de-recognizing asset, credit, right? When decreasing, credit. So dear children, what's the double entry for this annual depreciation 100,000? We need to debit to the relevant expense account. Depreciation on machinery account debit. Depreciation on machinery account debit. You need to recognize this 100,000 as an expense. That's why we need to record this in the profit and loss statement, statement of profit or loss. In other words, income statement. So expense account debit, depreciation on machinery debit, and because of depreciating, asset value should decrease. So directly we don't credit to the machine account, because there you can see the cost of the machine. Even though you depreciate, the cost doesn't change. So however, because of depreciating, asset value should decrease. Therefore, that decrease because of depreciation, the decrease in asset because of depreciation, we need to present by using another asset account without recording it in the machine account. So what is that account called? You already know, accumulated depreciation. So accumulated depreciation on machine account, credit 100,000. 100,000. See, by using accumulate depreciation account, you need to present the decrease in asset due to depreciate. So finally, you have to write down narration as well. Recording annual depreciation on annual depreciation on machinery amounting 100,000 rupees. So this is how we record journal entries for the depreciation account debit, accumulate credit. Right. Now we can move to the next part of this question. We need to present these in the ledger as well. First, we record transactions in prime entry books. So the general journal or a prime entry book. This is also a prime entry book. And Secondly, we have to update these in the ledger as well. Until you update these in the ledger, you can't see any double entry for the depreciation, annual depreciation in the ledger. So get ready, let's prepare the ledger now. Okay, dear children. So let's present the depreciation and the asset value in the ledger. So first of all, business bought a machine by spending 1,005,000 because you calculated the cost. So business bought this on cash basis, just assume. So here we can recognize after buying machines, the asset called machinery should increase. So I will debit to the machine account by mentioning cash. We bought it at a cost of 1,005,000. See, 1,005,000. Motor vehicle, while debiting, you need to credit to a cash account. So here I'm not going to prepare the cash account. Machine account debit and spent amount you need to credit to cash. Okay, so first place we recorded the cost of the machine. Machine account debit 1,005,000 because we bought it at 1,005,000. Remember, machine account debit, cash account credit. Okay, then during this annum, business depreciated the machine by 100,000. We depreciated the machine by 100,000. So we need to present that also in the ledger. So I will prepare here an expense account, that is depreciation account. So depreciation on machinery account. So this is an expense account. As well as to present decrease, I want credit here. We need to open another asset account called accumulated depreciation on machinery account. Dear children, this is an asset account which you use to present decrease in asset. What is this account? This is actually an expense account. Okay, let's record the double entry. As same as you recorded in the general journal, the same double entry you need to update in the ledger. You need to recognize the expense or debit. So I will debit here how much? Annual depreciation 100,000 rupees. By mentioning what? We need to transfer this amount to the accumulated depreciation account. So depreciation expense debit by mentioning the name of the other account, and accumulate depreciation credit. You need to decrease the asset after recognizing the expense. You have to decrease the asset. You need to present the decrease in asset as well. So accumulate crediting. What we are crediting to the accumulate? Annual depreciation 100,000. Right. Okay, dear children. So this is how we need to record double entry for the depreciation. Depreciation expense debit, accumulate depreciation credit. Put a machine account, machinery account means an asset account. Finally, you can balance off this. Asset accounts we can balance off, right? We don't have to close now. So finally, dear children, after balancing of this asset account, we need to present the cost of the asset in the SOFP. You can balance off on your own. Highest total after recording in the credit side, then BCD, BBF. So assets we need to present in the SOFP, no? So this goes to the SOFP. But depreciation expense account actually is an expense account, so you can transfer this to the P&L. You can transfer this to the P&L, no pointing bringing this to the next year. So directly at the end of the year, we can transfer this to the P&L. Profit or loss, to calculate profit or loss. Right. And remember, this is an asset account. Here we present decrease in asset. Depreciation expense debit, and we didn't credit to the machinery account to decrease asset because there you can see the cost of the machine. What is this 1,005,000? The cost that we bought. Even though you depreciate, Gatagana when a swin cost doesn't change, no? So that's why we use an additional account to present the decrease in asset. This is also asset account. This is also an asset account. So dear children, this also you need to BCD and BBF. So finally we have to present in the SOFP because this is an asset account, you know, assets we had to present in the SOFP. So this is how we record double entry for the depreciation. First I recorded the purchase cost of the asset, machine debit, cash credit. I didn't prepare here cash account. And Annually we need to depreciate by 100,000. So depreciation expense debit, accumulate credit. Now we need to present extracts of financial statements. So this is the last part of this activity. We need to prepare extracts of financial statements. So here, dear children, we depreciated a non-current asset. So non-current assets, anyway, we need to present in the SOFP. So dear children, after preparing the structure of an extract of SOFP, under the heading of non-current asset, you need to mention here machinery, because machinery are non-current assets which we expect to use throughout number of years. So these non-current assets help to generate future economic benefits as well. So here, with this depreciation adjustment, we need to present the cost of the asset, and because of depreciating, the asset value decreased, so we need to present the decreases as well and the net value. Dear children, let's take the cost first. How much is the cost? You can see it in the cost account, in the asset account. So cost is 1,005,000. Cost is, carefully write down 1,005,000. First thing, you have to record the cost. Then how much did you depreciate out of the cost? You depreciated 100,000. Depreciation is an annual expense. So you need to mention here depreciation on machinery as an expense. What kind of expense? That is an administrational expense, office related expense. You can see these machines at the office. These are for the office use. So because of depreciating, we have recognized such decrease in non-current assets as an administration expense. So depreciation account debit, and as same as recognizing the expense. Same. Because of depreciation, asset value should decrease. So let's present the decrease under the accumulate column, 100,000. So at the end of the first year, tell me the net value. When we present information through financial statements, always we need to present accurate information. At the beginning, initial measurement was 1,005,000. The value of the machine was 1,005,000, but subsequently it is not. Now the value is in 1,005,000. After depreciating, already depreciated 100,000, it should be 905,000. 905,000. So this is how we need to present, my dear children, depreciation in the financial statements. And I will show you you don't have to write this. I will show you the situation where you can see, I will show you, my dear children, the SOFP with regard to second year as well. And under the same question, I will show you the next year SOFP as well. You don't have to prepare, right? So machinery, don't write down this, but this is a very important thing. Tell me the cost during the second year also. The cost doesn't change. The cost doesn't change. 1,005,000. You bought this machine for 1,005,000. 1,005,000. Then, dear children, during the second year also you need to depreciate 100,000. Right? So it goes to the P&L of the second year. This is the first year P&L, no? Just assume. You can see another one. So other than this 100,000, we depreciated another 100,000 during the second year. In a depreciation account, debit 100,000. As same as the previous year, you have to credit to the accumulated depreciation. So previous year we depreciated 100,000. Currently also we depreciated 100,000. And how much should record here? You can see 2 years depreciation now. So while depreciating, my dear children, during each year, accumulate depreciation value will increase. Once you depreciate, accumulating value will increase, because when you depreciate, asset value should decrease. And now in the second year, asset value will be, at the end of the second year, asset value will be 805,000. So when you depreciate, asset value further decrease, and the net value getting decreased. Right? This is the second year SOFP. So you don't have to record, dear children. So however, keep that in mind. It is very important. So we completed activity number 8.